What is ETF and how to invest in ETFs? Hey everyone, and welcome back to the channel. Today we're diving into a topic that's been a game changer for investors all over the world, ETFs. You've probably heard the term thrown around, but what exactly is an ETF? More importantly, how can you start using them to build your wealth? Stick around, because by the end of this video, you'll have a crystal clear understanding and be ready to take the next step. So let's start with the basics. The ETF stands for Exchange Traded Fund. Now I know fund sounds a bit intimidating, but let's break it down with a simple analogy. Imagine you're at a massive grocery store. Instead of buying individual ingredients one by one, an apple here, a carrot there, a loaf of bread, you can buy a prepackaged meal kit. This kit might have all the ingredients for a week's worth of Italian dinners. It's convenient, it's diversified, and you get a variety of items in one single purchase. An ETF is just like that meal kit, but for investments. Instead of buying individual stocks, like one share of Apple, one share of Google, and one share of Amazon, you can buy a single share of an ETF that holds all of those companies and many more. It's a fund, which means it's a collection of asset stocks, bonds, or even commodities like gold. And the exchange-traded part simply means you can buy and sell it on a stock exchange just like a regular stock throughout the trading day. Right? Pretty neat, right? You get instant diversification with just one click. Now, you might be thinking, okay, that sounds a lot like a mutual fund. And you're right, they are similar. Both are baskets of investments, but there are a few key differences that make ETFs incredibly popular. First, as we just mentioned, ETFs trade like stocks. You can buy and sell them anytime the market is open, and their prices fluctuate throughout the day. Mutual funds, on the other hand, are typically priced only once per day, after the market closes. This gives ETFs a bit more flexibility. Second, ETFs often have lower fees. The costs associated with managing a fund are called the expense ratio because many ETFs are passively managed, meaning they simply track a market index like the S&P 500 and do not have a team of highly paid managers. Actively picking stocks, their operating costs are generally much lower. Over the long term, even a small difference in fees can have a massive impact on your returns. A 0.5% difference might not sound like much, but on a large portfolio over 20 or 30 years, it can add up to thousands or even tens of thousands of dollars. And third, there's transparency. With most ETFs, you can see exactly what stocks or bonds it holds on any given day. This transparency gives you a clear picture of what you're actually investing in. So, to recap the big advantages: diversification, low costs, flexibility, and transparency. It's a powerful combination that has made ETFs a go-to choice for both beginners and seasoned pros. Let's look at some examples to make this even clearer. One of the most famous types of ETFs is an index ETF. For instance, an S&P 500 ETF aims to mirror the performance of the S&P 500 index, which represents the 500 largest publicly traded companies in the US by buying just one share of this ETF. You're essentially investing in a tiny slice of all 500 of those major American companies. You get exposure to tech giants, healthcare leaders, financial institutions, and more, all in one package. But it doesn't stop there. The world of ETFs is incredibly diverse. There are sector ETFs that focus on specific industries like technology, healthcare, or energy. So if you're really bullish on the future of clean energy, you could buy a clean energy ETF. There are also bond ETFs, which hold a collection of government or corporate bonds, offering a generally more stable, income-focused investment. You can even find commodity ETFs that track the price of gold or oil, and international ETFs that give you exposure to markets in Europe, Asia, or emerging economies. Whatever your investment strategy or belief about the market, there's probably an ETF for that. All right, you're convinced. ETFs sound great. Now for the million-dollar question: how do you actually invest in them? The good news is, it's surprisingly straightforward. The process is almost identical to buying a share of a company like Disney or Nike. The very first step is to open a brokerage account. A brokerage account is simply an account that allows you to buy and sell investments like stocks, bonds, and, you guessed it, ETFs. There are many reputable brokerage firms out there. Think of names like Fidelity, Charles Schwab, Vanguard, or newer app-based platforms like Robinhood or Webull. Do a little research and choose one that fits your needs. Look for things like low or zero commission fees for trades, a user-friendly platform, and good customer support. Opening an account is usually a quick online process that takes just a few minutes. Once your brokerage account is open, the next step is to fund it. It's just like transferring money into a new bank account. You can link your regular checking or savings account and transfer the amount you want to invest. A key piece of advice here: only invest money you won't need in the short term. The stock market goes up and down, so you need to be prepared to leave your money invested for the long haul to ride out any bumps. Okay, your account is set up and funded. Now for the fun part, choosing your ETFs. This is where a little bit of research comes in. You can start by thinking about your goals. Are you looking for long-term growth? You might consider a broad market index ETF, like one that tracks the S&P 500 or the total stock market. Are you looking for something a bit more stable that pays dividends? A dividend ETF or a bond ETF could be a good fit. When you're looking at a specific ETF, there are a few key things to check. First, look at its holdings. What's actually inside? Make sure it aligns with what you want to invest in. Second, check the expense ratio. As we discussed, lower is generally better. For a broad index ETF, you can find expense ratios as low as 0.03%, which is incredibly cheap. Third, look at its trading volume. A higher volume generally means it's easier to buy and sell. Most major ETFs from large providers like iShares, Vanguard, and SPD will have plenty of volume. Once you've picked your ETF, it's time to place your order. In your brokerage account, you'll use the ETF's ticker symbol, a unique 125-letter code, just like a stock. For example, a popular S&P 500 ETF has the ticker symbol SPY. You'll go to the trade screen, type in the ticker, specify how many shares you want to buy, and choose your order type. For most beginners, a market order is the simplest. It just buys the shares at the current market price. Then, you click buy, and congratulations, you are now officially an ETF investor. You own a piece of hundreds, maybe even thousands of companies. From here, the key is consistency and patience. Many investors use a strategy called dollar cost averaging, where they invest a fixed amount of money at regular intervals. Say $100 every month regardless of what the market is doing. This helps smooth out your purchase price over time and builds a disciplined investing habit. Remember, investing in ETFs is generally not about getting rich quick. It's a long-term strategy to build wealth steadily over time by harnessing the power of the market and compound growth. Let your investments do the work for you. So there you have it. ETFs are essentially investment meal kits. They offer instant diversification, low costs, and incredible flexibility. You can invest in them easily by opening a brokerage account, funding it, and choosing the ETFs that align with your financial goals. It's a fantastic way for anyone to start building a well-rounded investment portfolio. Thank you so much for watching. I hope this explanation cleared things up and made the world of ETFs a little less intimidating. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to hit that subscribe button and ring the notification bell so you won't miss our future videos on personal finance and investing. If you have any questions, drop them in the comments below. I love hearing from you and will do my best to answer them. Till next time, happy investing.